Right now, we need to talk about one of the biggest, most crucial stocks in the American economy, United Parcel Service. You know them simply as UPS. For the past couple of years, owning the stock has been a roller coaster ride. If you jumped in during the craziness of the pandemic, you saw the stock shoot up like a rocket. But since early 2022, the party ended. The stock price has absolutely collapsed, falling more than 60% from its peak. That drop was brutal. And right now, the share price is actually sitting below where it was before the pandemic even started. Wall Street got overly excited when everyone was stuck at home, ordering everything online, and they figured that massive shipping demand would last forever. It didn't. When demand returned to normal levels, the emotional pendulum swung hard from pure excitement to total depression. This is a shipping giant that is vital to the entire world economy. It would be incredibly difficult, maybe even impossible, for anyone to build a new business that could replace what UPS has already set up. They run a massive operation, more than 500 planes, over 100,000 vehicles, and hundreds of sorting facilities delivering around 22 million packages every single day. This is a solid, enduring business, and right now, management is forcing through the most significant strategic shift in the company's entire history to make it even better. This shift is painful, and that is why the stock price has been crushed. Management looked hard at the business after the pandemic rush ended and decided they needed to make huge changes. The goal is brutal simplicity: cut costs, improve efficiency, and focus only on the packages that make the most money. This isn't a minor change, it's a massive corporate overhaul. The CEO calls it their strategic shift, designed to deliver long term value. It's expected to play out over the next few years, and it involves heavy capital investment to improve efficiency, closing down facilities that aren't making enough money, and drastically cutting the workforce. They are targeting $3.5 billion in cost reductions for 2025 alone, and they are already delivering. Through the end of the third quarter, they achieved about $2.2 billion in cost savings. That effort involves serious manpower changes. As part of this push, they have cut around 14,000 management jobs. They have also cut about 34,000 operational jobs. Furthermore, they have closed the daily operations in 93 leased and owned buildings since the beginning of the year. This is what a real efficiency drive looks like. They are trimming a fat everywhere possible to be a leaner, more profitable machine on the other side. The biggest, most aggressive move they have made is slashing ties with their largest customer, Amazon. Think about that for a second. They're deliberately pulling back from their biggest source of revenue. Why? Because that business was low margin. It wasn't profitable enough. The company reached an agreement to lower Amazon's volume by more than 50% by June 2026. In the third quarter alone, Amazon's total volume with UPS dropped more than 20%. This is a gutsy move, but the long term thinking is sound. Focus on higher profit shipments and rely less on any one customer. But the company is fighting more than just old habits. They are fighting the entire global environment. They have faced serious headwinds due to geopolitical uncertainty and high inflation here at home, which is hurting consumer confidence. They are dealing with changing trade policies, including the removal of a specific exemption that allowed cheaper goods, valued under about $800, to enter the country without additional taxes. This change has caused custom bottlenecks, forcing UPS to discard some international shipments because of severe delays. Despite these major obstacles, the company is determined to succeed. And that brings us to the latest earnings results, which just hit the market, and they were a massive win. For the third quarter, the company delivered adjusted earnings of $1.74 per share. Wall Street analysts were only expecting $1.30 per share. That's a 44-cent beat. Their total revenue came in at about $21.4 billion, easily topping the analyst expectation of about $20.8 billion. The stock reacted exactly how you'd expect when a turnaround story shows real traction, jumping more than 12% in pre-market trading. Well, their U.S. domestic package revenue was down slightly, about 2.6%, because of lower volume, a trend we see with overall softening online sales. Their international business segment was actually thriving. The international segment revenue grew almost 6%, thanks to a 4.8% increase in average daily package volume. This shows the global network is still pumping strong. On top of the earnings beat, the company gave very strong guidance for the crucial holiday shipping quarter, which lasts from November to January. They project fourth quarter revenue of approximately $24 billion, which is higher than what Wall Street expected. They also expect their adjusted operating profit margin to land between 11% and 11.5%. This beat and strong outlook signals that their cost cutting initiatives are finally flowing straight to the bottom line, proving the turnaround plan is working. In the third quarter, they also cleverly squeezed out extra cash by selling and leasing back 5 properties. This transaction brought in a gain of about $330 million, which contributed 30 cents to the adjusted earnings per share. This is part of their strategy to monetize real estate and reinvest that capital back into the core business for growth. Right now, traditional valuation metrics, like the ratios measuring price against sales, earnings, and book value, all suggest that the stock looks dirt cheap compared to its 5 year averages. This is exactly where you want to be when a good company is actively fixing its problems. Now, there is one major detail you absolutely must understand: the dividend. The stock currently offers a huge dividend yield of about 7.5%. That looks amazing when the average S&P 500 stock only yields around 1%. Plus, UPS has increased that dividend for 16 straight years. But here's the catch: you cannot buy the stock just for the dividend. You must look at the math behind it. The percentage of cash flow they use to pay that dividend is dangerously high, about 150% over the last year. When a company is doing a major business reset like this, the board of directors can easily decide to cut the payout. It would not be shocking. If the dividend survives this overhaul untouched, consider it a bonus or icing on the cake. The main reason to buy here is for the business turnaround itself. If you're looking a few years down the road, you might deeply regret missing the chance to buy this company right now while Wall Street is so shockingly negative. They are fine tuning a critical, irreplaceable business. The long term demand for shipping is only going to grow as online shopping expands. UPS is executing the hard work needed to become a better, more profitable company. This is a classic turnaround story, and the third quarter results just provided the clearest signal yet that they are on the right track. This is not the time to be focused on the short term noise. This is the time to look at where this giant package delivery machine will be in 5 years. If you want to stay ahead of the game with simple, direct stock analysis, make sure you hit that like button, subscribe to the channel so you don't miss our next video, and ring that bell notification. Thanks for watching, and I'll see you next time.